Welcome to This Explainer. If you've been looking for a safe harbor in today's incredibly volatile market, you've probably noticed Coca-Cola's massive recent momentum. So today, we're acting as financial detectives. We're going to dive right into the numbers, the leadership, and the strategy to figure out exactly what's driving their dominant market position right now. Okay, let's take a quick look at our roadmap for today. We'll cover their standout market performance, break down Q2 2026, look at their strategy and new leadership, ask if the valuation is justified, and finally wrap things up with key risks and the future. All right, part one, Coca-Cola's standout market performance. Let's kick things off by looking at just how significantly they've stood out as a safe haven lately. Check this out. A massive 23.7% year-to-date surge in their stock price. Now, when the broader market gets turbulent, we all know investors flock to safety, right? But a near 24% jump for a massive legacy company means Coca-Cola isn't just surviving the chop, it is actively thriving. So why exactly is capital flocking here at such an aggressive rate? That brings us to part two, breaking down Q2 2026. This market momentum is really built on the foundation of a truly blockbuster second quarter. So the crucial thing to understand here is that this wasn't just a slight beat. I mean, a 5% jump in unit case volume, if you strip out that weird COVID recovery period, that is literally their strongest volume growth in 17 years. Plus, organic revenue grew by 6%, pushing bottom-line earnings to 97 cents per share. That's an 11% increase that easily topped analyst expectations. And yeah, it even got a nice little bump from a currency tailwind. Now here's what's actually kind of wild about these numbers. The flagship Coca-Cola brand had solid 5% growth, sure, but it was actually outpaced by sports drinks. Powerade surged by a massive 8% globally. And honestly, this wasn't just by chance. It was heavily fueled by some incredibly successful marketing activations around the FIFA World Cup. On top of that volume, the company showcased immense pricing power. They expanded their comparable gross margin by 120 basis points and their operating margin by 90. Achieving that kind of expansion despite persistent inflation and input cost pressures, that proves they have fierce, incredibly disciplined cost management. It was so strong, in fact, that management actually raised their full-year guidance, now expecting around 5% organic revenue growth. Moving right along to part three, strategy and new leadership, because this level of financial outperformance definitely isn't an accident. Remember those FIFA World Cup activations we just mentioned? Take their Panini sticker partnership, for example. That wasn't just standard marketing. They generated over 9 billion views and collected more than 25 million first-party data points. 9 billion. They are basically turning global cultural events into a massive, highly targeted data engine to guarantee future sales growth. It's brilliant. And this massive data engine, along with the company's broader strategic momentum, is now in new hands. Henrique Braun officially succeeded James Quincey as CEO. Quincey is staying on as executive chairman, but he made it very clear this was a carefully planned transition, expressing a ton of confidence in Braun's ability to steer this next chapter. And Braun isn't some outsider. He's a true company veteran who started way back in 1996 and has operated all over the globe. Stepping into the top role, he's got 3 clear priorities to keep this momentum alive: seeking the best global growth opportunities, aligning much closer with actual consumer needs, and using technology, like that 25 million data point engine, as the ultimate growth enabler. Which leads us to part 4. Is the valuation justified? With raised guidance and fresh leadership, we have to ask the multi-billion-dollar question. Because, wow, Coca-Cola is towering at a 25.22 forward price-to-earnings ratio. To put that premium into perspective, the broader S&P 500 sits at about 20.81, and their main competitor PepsiCo trades way down at a 15.67 multiple. That massive 23.7% stock run-up we talked about earlier, it has pushed Coca-Cola into very, very deep premium territory. So the market is deeply divided right now. On one side, the bulls are looking at the ultimate safe haven, a pristine 55-year track record of increasing dividends and dominant market share. But the bears, they see a ceiling. In fact, Bernstein recently downgraded them to a market perform rating with an $84 price target. They're warning about regional headwinds, specifically an upcoming 2026 excise tax in Mexico that could really eat into Coca-Cola's international profits. And that brings us to our final section, part 5, key risks and the future. The market is pricing in absolute perfection, so let's map out the hurdles they actually face. Management essentially faces 3 looming hurdles. First, Balancing growth and profitability in Asia. They're investing heavily in India and China right now, which means sacrificing short-term margins for long-term scale. Second, there's a massive IRS dispute. They're awaiting an appellate court ruling within the next 6 to 12 months that carries huge financial implications. And third, an uneven global consumer landscape. With real pressure on low-income shoppers, Coca-Cola has to expertly balance affordability with premiumization. Coca-Cola is undeniably a resilient powerhouse, and they're navigating a complex environment with some serious momentum right now. But with the stock currently priced for zero errors, we have to leave you with one final thought. As we look ahead to some potentially volatile quarters, can Coca-Cola continue to execute flawlessly, or is perfection simply too expensive?